Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 97 on January 17th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Valeris, Twitter, and General Motors, and then we discuss three new trades on California Resources Corporation, the S&P SPDRs ETF, and the Invesco QQQ Trust ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. So the biggest question this week is, how high can this market go? We had another week of all-time highs in the equity markets, with the Dow Jones Industrial Average gaining 524 points, closing at 29,348 points on Friday. The S&P 500 index picked up 64 points this week, ending the week at 3,329 points. And this is the part of the show where we get into the topic of the week. The topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. The topic I wanted to discuss this week is, how do you trade all-time highs? We may have touched on this a few months ago, and I definitely wanted to highlight a couple of things because that's where we are. So how high can this market go? Who knows? Does it have to come down? Typically, eventually, but who can guess when? I certainly can't. So I'm going to trade as if we're going to keep making new highs, and when it's time to adjust, I'll go ahead and adjust. So, if you're seeing all-time highs, you don't necessarily, spend all of your money buying a new share of stock, right? You're not going to you don't want to buy all-time highs. You'd rather buy all-time lows, right? But in options, it's a little different. So in general, you want to trade strategies that benefit from prices going higher. So what goes up when the price goes up? That means buying call options, selling puts, right? And that goes the same for buying call spreads and selling put spreads. And you'll see in the review of last week's trades, it's like, what was I thinking buying a put spread, right? You can't guess when this market is going to go lower, or if it's going to go lower anytime soon. So keep trading and making trades as if it's going to go higher, but just be aware that many times all-time highs have been followed up by some sort of a retesting of the lower ends of the market. So keep it simple. I like buying call spreads and selling put spreads. Just keep it super simple. Remember, and we're not going to belabor this point this week, but the best trades are the ones that make you the most money. It doesn't matter how advanced or complicated the strategy. I actually spent a good chunk of this past week focused on cryptocurrency trading, and there are all sorts of people that try to get super complex, and honestly, what makes money is just keeping things super simple. So that's it. Focus on trades that are going to benefit from all-time highs, and just save some ammo for when this market does turn. But it might turn next week. It might not turn until, November, when we have another election. So keep it simple. Find simple ways to make money. And if you find one that works for your personality and the way you look at the markets, keep doing it over and over and over. Never get tired of pressing a money button that looks easy, right? If it's easy and it's opening the cashier for you every time, keep pressing it. Keep pressing it. When people throw around more complex trade strategies, hey, what do you think about trading the Buttafuoco? And that is actually a trade. you don't have to do it. If it makes sense for you, do it. But if it doesn't, walk away, go back to hitting your easy button, your money button, and that's it. The best trades are the ones that make money. So that's it for the topic of the week. Let's just go ahead and get into the trade review this week. And of course, last week we started with some February trades. So we'll start off with the covered call. We looked at Valeris PLC, symbol V as in Victor, A as in Alpha, L as in Lima. At the time, the stock was trading for $6.23. We looked at buying that stock and selling the February 7 call at 40 cents, hoping for an 18.78% return in 6 weeks. Valeris stock fell 55 cents this week, closing at $5.68 per share. The call we sold can be repurchased for 20 cents, locking in a 20-cent gain on the option and a net loss on this trade of 35 cents. So given that we have 5 more weeks left until February expiration, I definitely would look to roll the strike lower on this trade. The way you do that is you would buy in this February 7 call, which you sold, and then turn around and sell the February $6 strike call option. You would still collect 40 cents for selling that, which immediately puts this trade back into the profit mode. It will lower that maximum return that you could attain over this trading period because of the lower stock, the lower value that you'll get from a stock move. But nonetheless, our goal is always to make money, or number 2, to mitigate or reduce the risk in the trade. And so rolling the strike lower will certainly do that and keep this trade positive, even if it's only marginally so. So that's it for the covered call. We'll look at the credit spread next. We looked at Twitter Inc., symbol T as in Tango, W as in Whiskey, T as in Tango, R as in Romeo. At the time, the stock was trading for $32.78 per share. We looked at selling the February 32-31 put spread for collecting 39 cents, and that can create a maximum possible loss of 61 cents per spread. So Twitter stock picked up $1.44 per share, ending the week at $34.22 per share. The out-of-the-money put spread we sold is even more out of the money now, so that's great. If you were to repurchase the spread, you would lock in a profit of 6 cents, but you would also be crossing the bid-ask. So since our goal is to keep the full 31 cents that we received when we sold the spread, right now, if we were to close this trade out, you would only capture 20% of your maximum gain. So you definitely want to stay in this trade if you decide to take it on. Now, you can also add to this trade if you'd like to make it a little more complex by selling the February 38-39 call spread at 17 cents. So this would raise your total possible gain from 31 cents to a total of 48 cents on the spread. It also lowers your maximum possible loss from 69 cents to 52 cents per spread. Now, of course, this trade is making money, so there's no real adjustments that are needed. But that being said, selling this call spread, depending on where you think Twitter stock will top out on the high end, might also be worthwhile for your overall risk profile. So take a look. You can stay in this trade, or you can add to it by selling that call spread against it. But overall, this trade made money because stock market went up and we sold a put spread, which benefits when prices go down. So again, keeping it simple is never a bad thing. And then our final trade last week, the one I'm kicking myself for, of course, is the debit spread on General Motors, stock symbol G as in Golf, M as in Mike. At the time, or last week, the stock was trading for $34.65 per share. And I looked at buying that February 36-35 put spread for 63 cents, which can give us a maximum gain of 37 cents or a 58% return in 6 weeks, which is of no real importance because I bought a put spread when we were in all-time highs. So, take this as a lesson. I should not have bought a put spread when we have been bumping against all-time highs. So GM stock gained 95 cents per spread this week, closing at $35.60 per share. The in-the-money put spread we purchased is now at the money, you can sell the spread at 43 cents, which would lock in a loss of 20 cents. Or you can decide to trade something else against the spread. Your best bet for an add-on trade would be to sell a lower put spread. So looking at the price chart, I'm not convinced this stock is actually heading too much higher. I think it benefited from the overall market. I'm leaning more towards holding on to this trade, even though I'm beating myself up for the weekly result. This trade still has 5 more weeks left. So, for those of you who are more methodical, of course, I do want to point out the fact that the break-even point in this trade has been reached. So that should, sometimes I use that break-even point as a trigger for being able to exit a trade before reaching a true loss. And sometimes it makes me just rethink the entire trade idea. I'm not exactly rethinking this one, but I am cautious with regards to my previous statement about being long put spreads when market is making new highs. The market can always go higher. So just keep that in mind and trade according to your own risk profile. So let's get into this week's trades. Today is actually January options expiration. So all of your January trades will either be priced at their intrinsic value or have expired worthless. So hopefully everything you bought finished being worth something, and everything you sold went all the way to zero so that you could keep all that money in your account. The other thing to keep note of for this week's trades is the fact that many of these trades many of the stocks will offer the 50-cent strikes on Monday. They'll start pricing those in. So you always take the trade ideas this week with a grain of salt, because you might have better pricing come Monday morning when the 50-cent strikes are open. So we're going to start off as usual with the covered call. This week I'm looking at California Resources Corporation, symbol C as in Charlie, R as in Romeo, C as in Charlie. Stock ended the week at $8.49 per share. I'm looking at buying that stock and selling the February 9 call at 70 cents, hoping for a 14.25% return in 5 weeks. Now you enter this trade by buying CRC stock for $8.49 per share and selling the February 9 call at 70 cents. This trade makes the most money if stock prices finish above $9 per share, and the break-even price on this trade is $7.79. So the actual stock purchase would require $849, and then you would collect $70 for selling this option. The next trade for the week, we're looking at a credit spread on the SPDRs. The SPDR S&P 500 ETF, symbol S as in Sierra, P as in Papa, Y as in Yankee. The stock ended the week, or the ETF ended the week at $331.61. And I'm looking at selling the February 330 put spread, collecting 31 cents for that spread. And that creates a maximum possible loss of 69 cents per spread. Now you enter this trade by selling the February 331 put at $3.62 and concurrently buying the February 330 put for $3.31. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish above $331 per share. The break-even price is $330.69. So you would actually receive $31 per spread that you sell and have $69 per spread at risk if you were to enter this trade. And then our final trade for this week's show, and sorry it's a little bit shorter show, but I decided to come in and give you exactly what you needed. We're looking at a debit spread on the triple Qs. That's the Invesco QQQ Trust, symbol Q as in Quebec, Q as in Quebec, Q as in Quebec. Stock ended the week at $223.38 per share. I'm looking at buying the February 223 call spread, paying 69 cents for the spread, and hoping for a maximum gain of 31 cents per spread or a 45% return in 5 weeks. So you enter this trade by buying the February 222 call for $4.81 and concurrently selling the February 223 call at $4.12. This is a debit spread because we are buying the spread, And this trade makes the most money if stock prices finish above $223 per share. The break-even price on this is $222.69. Now in real dollars, you will pay $69 to enter this spread, and your maximum gain is $31 per spread. So that's it for this week's show. Thank you guys so much for listening. I'm actually backed up on a few email, but thank you guys so much for reaching out. I will wrap up. I'll get back to the email and connect with everyone soon. You guys are amazing. If you enjoy the show, please share it with a friend, and thank you so much for listening. Take care. Have a wonderful weekend. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.